Welcome, everybody. Today, if you're somebody who is looking for how to invest in the stock market, because I think you might have heard that there are various ways in which you can actually play in the stock market. I mean, I do admit that the play is not the right word, but if you want to invest in the stock market, there are various ways. People would say that there is investing, and there would be people who would say, I'm more of a trader. Today, we're going to talk about a very interesting strategy that is actually employed by one of the world's most foremost billionaire investors, Mr. William Bill Ackman. Now, ladies and gentlemen, who exactly is William Bill Ackman, right? I think you might have heard of Mr. Buffett. Now, if I would say to you that if there is another person who's a little bit younger than Mr. Buffett and who is as successful, if not maybe in the future will be even more successful than Buffett, what names come to your mind? Now, you might not have an idea. If you're somebody living in India, you might not be aware of that. But I think you might be aware of Indian stock market investors such as Radhakrishnan Damani and some of the other well-known investors like Rakesh Jhunjhunwala. But Mr. William Bill Ackman is another big investor who has actually earned millions just by investing. So let us start with the presentation. I'm just going to go to the full screen and yes. So he is Mr. William Bill Ackman. You might have seen his face, some of you might not. But that's not really the of importance in here. No matter who they are, it's very important to understand what kind of strategy that they use for investing in the stock market. Mr. Bill Ackman invests in a way like Mr. Buffett. So he has learned a lot from Mr. Buffett, and obviously Mr. Buffett has learned from his teacher, Mr. Benjamin Graham. So obviously Mr. William Bill Ackman also belongs to the camp of Mr. Buffett, which invests according to value. So basically, he is a value investor, right? He is a value investor, or should I say precisely, he's a value fundamentals investor. Okay. Now, some of you might be confused. Value fundamental investor, what does that mean? So, in investing, when it comes to the stock markets, there are two approaches that people view the things. Some people believe that it is completely not in any way. There are some people who believe that the stock market is just the thing where is a place, a market where things just go up and down. There's a lot of volatility. But if you're really going to talk about what is a stock market, you need to first understand the definition of it, right? What is a market, ladies and gentlemen? A market is a place where buyers and sellers meet, right? So a stock market is a place where stock buyers and sellers meet. So the idea of a stock is a very old concept, right? I mean, the idea of a stock market started like some like 20 years ago or 30 years ago. Not, I'm really sorry, it's not 20 or 30, it's maybe like 200 or 300 years ago. I do not know the exact date, but it's a very old idea. And Mr. William Bill Ackman, he runs a famous hedge fund. So let us go briefly to his introduction. Mr. William Bill Ackman is an activist investor. Now I will basically explain to you what are the different kinds of investors by opening my OneNote and clear your doubts. But here in this slide, I will be explaining to you who is Mr. William Bill Ackman. Mr. Bill Ackman is an activist investor. He's a concentrated investor. Now, what is the meaning of the word concentrated? Concentrated means it is not investing in like 100 or 200 stocks, right? Many people, if you see in the stock market, they will be like investing in 100, 200, 300. They will be holding these many stocks in their portfolio. But Mr. William Bill Ackman, he only owns few stocks in his portfolio. Sometimes he had 5 stocks in his portfolio, sometimes he had 9. So at any single point of time, he never held more than 10 stocks in his portfolio. And Mr. Buffett currently holds only 5 stocks or 6 stocks in his portfolio. So he's also like Mr. Buffett. He basically believes, why do you want to invest in your 10th or 20th best idea when you can actually invest in your top 5 or 6 ideas, right? Now, I know that when you're starting with investing, people would advise you to start to go and invest in the index funds, where like, for example, the most famous of it would be like Nifty 50, or maybe you want to invest in the American stocks through the S&P 500. So you're holding, like 50 to 60 stocks in your portfolio, right? When you're basically buying an index, you're buying all the stocks that are inside the index, right? Obviously, the weight of each stock in the index will be determined by the market capitalization. Now, all these terms I will explain to you going forward. But remember, Mr. Bill Ackman is an active investor. He's not a passive investor, right? There are two kinds of investing: active investing and passive investing. Passive investing is kind of like, you do not check what is in your portfolio. You're just going to buy the whole index and just stay put. You're going to look at your portfolio after 20, 15 years. Whatever happens, the market goes up, the market goes down, you're not going to do anything to your portfolio. Mr. William Ackman invests in a different way, right? He's an active investor. See, again, he's an activist investor, but activist investor is someone who is an active investor, right? Not all activist investors are active investors, but all activist investors are active investors. Mr. Bill Ackman invests. He looks at his own stocks. He selects his own stocks. He looks at the fundamentals. He looks at all the kinds of companies, and he selects his own set of stocks and he invests in them. He invests in his 6 or 7 best ideas, which he thinks to be of very good quality stocks. Now we'll come to his philosophy going forward, but basically he's a founder and CEO of the Pershing Square Capital, which is a hedge fund run by him. He's a CEO of that, and it's the second largest hedge fund. Right. So basically, what is a hedge fund? A hedge fund is basically, it's available for this high net worth individuals and who have, lots and lots of money with them, like millions and millions of money. These people, they have a lot of money to spare, so they give their money to the hedge funds. These hedge funds employ a lot of trading strategies, right? Unlike the normal mutual fund manager who basically has to do whatever he wants, a hedge fund has a lot more leeway, a lot more freedom in its operations. But keep the definitions aside. You have to just remember that he's one of the leading investors in this world. He runs this famous hedge fund, which is the second largest hedge fund in the world, and he's an active investor, and he is a concentrated investor. He believes in investing in his top ideas, top 5 to 6 ideas, rather than investing in his top 50 or 60 ideas. Right now, moving on to the next slide. Now, what is Mr. Bill Ackman's strategy? Right. So the strategy is amazing. So basically, he has these principles when it comes to investing. He says, I will only invest in companies which are very simple, predictable, free cash flow generative, dominant businesses, which have a very strong moat, which have very high barriers to entry. Now, yes, let's unpack all these words, right? What is the meaning of simple and predictable? That means the businesses are not really that hard to understand. For example, I say, well, I'm investing in a company that is like producing this megawatts of power and coupled with all sorts of solar energies or whatever. So I'm actually complicating things a lot, right? I mean, it's a very complicated company. Even the person himself, who is like the owner of the company, will have a very hard time, making sense to people about what his company is. But Mr. Ackman says, well, I will only invest into companies which are simple and which are predictable. That means it's not really very hard to predict the industry. For example, what do you think will happen in the 2032? Do you believe that cloud will be still the leading cash cow for all these technology companies, or do you think some other technology will come and maybe disrupt the whole network? Now you might say, well, there's a possibility of that. I mean, 10 years ago we had old technologies. Now we have new technologies, and these new technologies have come to replace these old technologies. So technologies are, by their very definition, disruptible. They're very innovative. So you're going to create your company today, maybe it'll stop being relevant in the future. For example, there's some companies that you might remember which have completely gone out of the space, right? New companies came and disrupted them. For example, BlackBerry, Motorola, they were one of the premier mobile companies. Now they have been disrupted by another group of companies. But Mr. Bill Ackman uh, believes in very indestructible companies, which are very simple and predictable. Okay. What is free cash flow? So, free cash flow, ladies and gentlemen, the definition of free cash flow is that, for example, you are running a business, and through the running of the operations, you have earned some money, right? So, this is referred to as the cash flow from the operations, right? You're running a business, you have done some operations, and you have earned some money. That is called as cash flow from the operations. Now, obviously, all the amount of money you get from the operations, obviously you will not be using that, you will not be taking it as profit. Some of it must be used for making, taking care of the equipment, and some other expenditures that must come with, a lot of capital. So you are earning some money from your operations, and you're subtracting that from the amount of expenses that you need for managing the company. For example, you might need to give the salaries to your employees, you might need to, give some dividends. I will be briefing you about dividends as well, maybe in another video. You must be, buying some new equipment, you need to, kind of like maintain your old equipment as well, so you have some capital expenditure. So free cash flow is the difference between the cash flow from the operations and the capital expenditures that you incur, right? So he wants to invest into very high free cash flow generative companies. That means they earn excess of their capital expenditure. That means if the capital expenditure is $20, the company, by just investing $20 into the company, will be able to earn $150. Such a company is called as a very high free cash flow generative company. So Mr. Ackman believes in investing in such companies, right? And what is the fourth principle of his investment strategy? The business must be a dominant business, ladies and gentlemen, right? For example, if you're looking at some of the major brands right now, if you look at in some of the stocks in Mr. Portfolio, there's a stock called as Restaurant Brand International. Now you might say you might not have heard of Restaurant Brand International, but you might have heard of the chains that are managed by Restaurant Brand International. I think you might have been heard of the Burger King. Maybe you have been at one of these restaurants. You might have even tasted their burger. But have you ever thought of investing in the Burger King? Yeah, Burger King is a stock. It comes under the bigger brand, Restaurant Brand International, where it manages four big dominant brands. Now, what are these brands? Tim Hortons. It's a very famous brand in America. It's gonna soon open in India, and it also operates Burger King. So it's a franchisee based business, right? I mean, these people, they give the rights of opening these businesses in other countries and in other areas, and they derive royalties from that, right? It's a very very dominant business. You might have seen Burger King in each and every city in India. If you go to the United States, you're going to see a Burger King, on a road trip. You want to see one or two Burger Kings while you're traveling or journeying, right? Tim Hortons is very famous in Canada. I think it's famously known for its drinks. So Tim Hortons and Burger Kings are generally seen together in America and Canada, right? I mean, one would go for eating burger and he would say, "Well, I'm thirsty." Now, what would you do? You would go on to the next one, the next shop beside it, the next restaurant beside it. That is Tim Hortons, and you have some milkshake, right? A very great strategy. It also owns another famous franchise called Popeyes, right? Some of you might have even heard of that particular brand. And the fourth brand it owns is Firehouse Subs. It is also a very famous brand. So you're basically looking at very big dominant businesses that are very well known names in the industry that have a tremendous growth potential. For example, India is just developing. In the coming years, you're going to see much more cities coming, and much more Burger Kings are going to open in India. China is already flooded with Burger King restaurants. Russia is also, the whole Europe is spread. You also have some other developing economies such as South Africa, Brazil, etc. A very big growth potential backed by a very strong brand. They make the best burgers in the industry. They make the best milkshakes in the industry. They make the best, I think, I've never tasted a hot dog. It also seems that it's on the menu. So yes, they're very big brand businesses. And what is the meaning of strong moat? Right? The moat is a word that is often used by Mr. Warren Buffett. Now, what does the moat mean? Moat generally, ladies and gentlemen, means the competitive advantage of a business. For example, take the example of Apple. right? Apple has a very strong moat. Now, just imagine how many people use Android on a daily basis. Many people, and then a company comes in and says, "Well, we're gonna give you this new phone. It's gonna cost you 3 times more than your average Android phone." Now, you might say, "Well, it's a stupid idea." At that time, it might have been a very bad idea, right? Because you're competing against what? You're competing against Android. But then Apple comes up and says, "We're going to offer my phone at 80,000 rupees, 70,000 rupees. It's up to the people for buying it or not." But what people thought was that Apple will cease to exist in the coming future. Apple will go extinct. Then what happened? Bummer. Apple is the most profitable company in terms of its revenues and its profit. It's the most profitable mobile company, it's the most profitable technology company, even when compared to Google and Microsoft. And how did it happen? It has a very strong competitive advantage. Turns out that the people who migrated to the Apple ecosystem did not ever want to go out of it. They were so addicted to the ecosystem. People are just so addicted of buying Apple phones, they just buy it. That's it. That's some of the same things that are shared, that's some of the same traits that are shared with some of the well-known brands like Coca-Cola. I drink Coca-Cola every day. I know it's a very bad habit, but yes, I'm addicted to the brand value. If someone is going to offer me, "Well, I made this soda for you," I'm not going to take it. I'm going to take Coca-Cola, I'm going to take a Thumbs Up, I'm going to take a Pepsi, right? They have very strong moats, right? What is the last and final principle of Mr. William Bill Ackman? He says high barriers to entry. Now look at this, right? Very high barriers to entry. You can basically create a software company online and monetize your business. They do not have high barriers to entry. Software and technology fields are one of the most easily penetrable industries, right? You have some users, you develop that, and it's going to be very easy. Just think about it. Mark Zuckerberg invented Facebook when he was studying in Harvard. Bill Gates founded Microsoft when he was studying in Harvard. Just think about it, right? These are very easy to start businesses, although I would say it's going to be very hard getting people, be used to technology. The upfront investment needed for making a technology company is literally zero, right? In many cases, just literally zero, just it costs a few couple of dollars. But when you want to create a distribution chain that is as vast as, say, a franchise like Restaurant Brand International, it's not going to be like you're going to start with one restaurant and you're going to be like, "Yeah, I'm going to open 100 such restaurants." It's never going to happen, right? It's going to take time, right? It's going to take time. Nobody can create Apple all of a sudden and say, "I'm going to make my phone, I'm gonna sell it at 80,000." Nobody's gonna buy it. Why exactly? Because it's a very new company. Apple has a very strong distribution chain. It has a very loyal base of customers. Burger King has a very loyal base of customers, and they're able to operate in thousands and thousands of cities. So they have a lot of money coming in. So if they wanted to open a new branch in some other country, they would be able to do it. Now, what about you running a shop in maybe a Kirana shop in your village? Will you be will you be able to open 100 such stores in like 100 different cities? It's not really possible. I mean, it can be possible if you're earning a lot of money, you have worked in the industry for 10 years. So it's going to be very hard for some other persons to come and, you know, penetrate into the industry and have a very considerable market share, right? You're looking at a pretty durable industries. So this is the investing style of Mr. Bill Ackman. So let's look at his stock portfolio, right? Let us look at his stock portfolio. So if you're looking at his stock portfolio, these are the total companies that are owned by Mr. Bill Ackman. The first company is Laos. So Laos is an American retail company. You might not have heard of Laos. Maybe some of you maybe have heard of Home Depot. Home Depot is a famous American home retail company. So Laos is the world's second largest home retail giant. Right? You want to do some home retail work. You want to maybe design some interior designs in your house. You want some furniture. Where do you go? You're basically going to some of these big retail stores, and Laos operates some of the world's largest, and in fact it is the world's second largest um, company in terms of the home retail. Now, the second company I think I've already talked about, it's Restaurant Brand International. It owns some of the very well known brands such as Tim Hortons, Burger King, and Popeyes. Now, the third company is a very boring company, but yet it's a very high free cash flow generative company. It is Canadian Pacific. Now, people might be saying it's kind of like sounds like IRCTC, right? That's basically it. Canadian Pacific is a very large chain of, it's a very big railway company that operates around North America, right? It runs from maybe like from the United States to Canada. So it supplies all the goods, right? All the essential goods that are required for the company, for the country. Like they're gonna, transfer the steel, the other minerals, and all of the kinds of goods that are required for a country to operate. It's as simple as, it's a very boring business, right? The country is every country is gonna need all the essential goods and services. So when you're talking about railroads, they're quite efficient. And if I wanted to start a railroad company, I can't basically go and start a railroad company, right? If people wanted to open a new software company, they can do it in a jiff. They can just open their laptops, maybe have an idea, and they can then create a new website. But if you want to make a railroad company, you're gonna build railroads first, right? You're gonna have these railroads built, and railroads have been being built from like 200 to 300 years. So Canadian Pacific is a very high barriers business. Nobody can come into the industry like a sudden and like, I'm going to come and start this railroad business. Well, it can happen if you are like somebody like Mr. Bill Gates, but even Mr. Bill Gates does not create his own railway company. What he does is that he owns the stocks of another railway company, right? That is basically what he does. If you want, you can go and check Mr. Bill Gates' portfolio. You're going to have another railway company in his portfolio. Even Mr. Warren Buffett also held these other railway companies in its portfolio. So very strong bands, indestructible, strong moats, very high barriers to entry, very profitable businesses. Now you might have heard of Hilton. Hilton is a very big multinational hotel company, right? It owns a lot of hotels. If you have ever been to Bangalore, you're going to see a lot of brands of Hilton. And if you're going to see the next one, the next company is Chipotle Mexican Grill. So basically, as the name itself says, it's a grill company. It was recently just started, like few years back. It gained a lot of popularity in the USA, and due to the pandemic coming in, a lot of business came because these Chipotle was like very active on the online front. So it's a very high growth business that has a tremendous growth potential going forward. And the last stock is Howard Hughes. Howard Hughes is a real estate company. What it does is basically it owns a lot of, what do we say, master plan communities. So you might ask, what is a master plan community? A master plan community basically is like a vast acres of land. You have some 10,000 to 20,000, or sometimes extending to 50,000 acres of land. And Mr. Bill Ackman is the founder and the chairman of the board of Howard Hughes Corporation, and he is the one who takes care of how much land should be left for lease, how many lands to be left for construction. So basically, now you're, for example, just imagine this: you have Texas. So Texas is a very big state, and you have a master plan community called as Woodlands in Texas, right? So Mr. Will Ackman owns a lot of such master plan communities, right? So these master plan communities have been rated as the some of the best rated master plan communities, some of the best safest place to live in the whole world. They are very, very, very high posh kind of like localities. You have some of the big companies. For example, the master plan community would be having everything inside it, right? A residential plots would be first left for lease. Some constructors would come, builders would come, they would build some buildings, some people, families would be buying some lands in that, some flats in there, they would start shifting, and then some restaurant chain comes and says, well, because there are many people in here, let us open a restaurant in here. Some other business can open, a clothes store can also open, shopping malls and big shopping complexes can also open. So it's a very high value business. If you're gonna be very much patient with it, a long-term value can be created. So these are the stocks in the portfolio of Mr. William Bill Ackman. He just basically owns currently six stocks in his portfolio. So he's completely against the holding of more than like 40 to 50 stocks in his portfolio, right? And it's also very important to understand that Mr. William Bill Ackman only owns a few stocks in his portfolio, also because it's going to be very easy for him to manage it. Like he manages some across some $10 billion or something in his assets under management. I think 10 to like 20 billion of dollars are there in his assets under management. So it's very hard for him to actually go and maybe like trade a few stocks, because if he's going to go out of a stock, the price is going to fall. So for a small retail investor, these strategies can work, but for a very big investor such as Mr. William Bill Ackman, he has billions and dollars under his management. It's going to be very hard for him to come out of a stock and go into a stock, because the news would spread and everything. So he just sticks with his simple and very consistent uh, money generating, wealth creation strategies, right? It's very simple. Now, if you ever want to understand how many other hedge funds are investing their money, right? You have some of the best investors out there. If you want to know what kind of stocks are there in their portfolio, I would suggest there is this site which is called as Hedge Follow. Let us basically go into there, right? And I will show you this. So this is the Hedge Follow site. I'm going to put it on full screen. Let's start. So if you go to this hedge follow site, if you're just going to type Mr. Bill Ackman, as I said, he is the founder and CEO of the Pershing Square Capital Management. And if you go there, you would be seeing all the stocks that are currently in his portfolio and the weight of each stocks in his portfolio. Let's search. I think it's going to take some time. Yeah, I think this site is a little bit slow today, but okay. Now you might say, are there any such stocks in the Indian market? Now you might say, obviously there are such stocks in the Indian market as well, and some of these best stocks are already inside the in the Nifty index, right? So if you ever want to understand, if you ever want to kind of like make your own analysis, maybe you can just open ticker tape. In this ticker tape, you can basically see you have screeners, you have stock screeners. You can basically have this, so you can basically select your stock universe, you can basically select your sector, you can also select the market cap. For example, as I said, let us try to apply Mr. Bill Ackman's strategy when it comes to the Indian market and see if it works or not. Let's see the performance of these companies. Okay, I just only want to check the large cap companies in the Indian subcontinent. I do not want to invest into disruptible companies. India is service industry is not considered as a disruptible technology companies, right? The service company gives service to whoever he wants, right? They can give service to banks, they can give service to all other kinds of technology companies as well. So you can't consider them as, disruptible companies. If there are any other companies which are like purely dependent on the cash flows for the sale of their products, such a kind of company can be omitted according to Mr. Bill Ackman. So let us do not focus on where you do not have an idea. I'm not going to focus on energy. I'm going to believe that consumers, right? Consumers. So these are the companies that produce the services and goods that are used by the retail investors. For example, I think you must have heard of Avenue Supermarkets. It's the name of the company that owns DMart, right? The DMart shops that you very much like because they give cheap discounts. So it's a consumer discretionary company. You have Maruti Suzuki, which is a car making company, and Titan Company, which is like watches and all. Tata Motors, Mahindra. So we can actually select a few more filters. You can. I don't want anything to do with the communication services. I'm gonna tell you the reason afterwards, but I'm just gonna go with consumer staples as well. Consumer staples are going to be like industries like companies like Britannia, Dabur, Godrej Consumer Products, even a company such as Hindustan Unilever, etc. You're going to have some banks, right? Any growing nation is going to have banks. Banks are not going to be disruptible. You have some of the best companies such as HDFC Bank, ICICI Bank, Hindustan Unilever, State Bank of India. Although I would not say it is not a very good stock, by the way. You have LIC, ITC, Bajaj Finance, Kotak Mahindra, Axis Bank, Avenue Supermarkets, Maruti Suzuki. So even if you're applying these filters, you have a heck of a lot stocks to depend on, right? And if you're basically getting all the analysis right, you can basically invest into these stocks, or maybe even swing trade these stocks and maybe earn money. So healthcare, I'm not so sure about that. IT, information technology, yes, India is very much famous for that. Utilities as well. So these are all the stocks that you can get, and you can add other filters as well. You have some of the other filters here. For example, here you have P ratios, the closing price, the market cap, etc. So you have every single thing in here. If you're looking at the performance of these companies, let us take the example of TCS, right? So if you look at this chart of TCS, and I'm starting it from the beginning. So TCS may be listed on the stock market at around August 2004. Now from that point of time to today, right now, I think December 30, 30th December 2022, you have a lot of stocks, right? If you want to see the returns of TCS, on an average, it has given a total returns of 2,578%, right? It has given a total amount of returns of 2,578%. That means on an average, it has given a total return of 20% a year. If you had just basically held on to TCS, right? If you want to look at the financials of the company because you don't know what kind of stocks you're investing in, right? So if you look at the revenues of TCS, they are basically increasing. EBITDA means profit has been generally increasing, net income, earnings per share. You have all this stuff. You also have the balance sheet. You're going to look at the assets and the liabilities. TCS is a very high cash flow generative company, right? If you can see, the free cash flow of TCS is 36,954 crores. Can you believe that? That means on its capital expenditure, TCS is just spending around 3,000 crores. From its operations, it is generating like 5,630, right? And it's also making investments in changing working capital, etc. as well. The capital expenditures have mostly remained constant. For a Bill Ackman strategy to apply, you need to have your capex, capital expenditure, constant. We can see for TCS, the capital expenditures are not really that variable. Like it's not like they have increased a lot. They've more or less remained the same, and this is completely compensated. Even if there's a slight increase, they're completely compensated by the increase in cash flow. Maybe they're trying to open the company in some other states, maybe they're trying to expand in other companies, maybe they're trying to invest in their research and development, right? Now if you're going to look at the other stocks that we have, so basically all these stocks that we have basically are some of the very well known stocks. So you can even have materials in here. I think some of the best known companies are Asian Paints, even ITC, which makes cigarettes and all. See, Adani is there, but see, in the beginning of the investment career, you need to be able to separate the wheat from the chaff. You will have all these wonderful companies, right? Nestle is a wonderful company. Tata Motors is a wonderful company. I would not say Power Grid Corporation of India is not a good company because, you know, it's a government company. It's not really profitable. So you can go to the cash flow statement. You can come up with your own collection of stocks, right? You can add your own filters. Maybe you can add your 5 year revenue growth, 5 year revenue growth, right? 5 year revenue growth. You want the revenue growth to be positive. You want the free cash flow to be positive. Free cash flow should also be positive, right? You also want some other kind of like filters you can add. You want to have debt to equity, very important, right? Debt to equity simply means the amount of loans you have taken against to the existing amount of money you have. You can take this stocks in your portfolio and you can basically start comparing yourself with that. The P ratios for TCS is currently 31. Historical revenue growth has been positive every year on year. It's going by 9%. Very good. Free cash flow is very much positive. Debt to equity is like 8.7, very less. Actually, it is 0.87. The percentage is a little bit similar. TCS has very low debt. So you need to be looking at values which are like below 12, or a below 12 would mean you have some monies to, and debt to equity ratio of 10 would mean that you have, it's not exactly right, but here 8.7 would literally mean 0.87. That means TCS debt is considerably very less to the amount of equity means the total value of all the shares that is currently trading on the stock market. But if for HDFC, you would see the free cash flow is negative. See, for banks and all, you should not use the free cash flow. You need to be looking at the balance sheet, okay? Because banks are completely different. Sometimes you have money going in, you have money going out. So the best way to see how to judge a banking stock would be to not look at the cash flow statement, but you need to rather look at the assets and liabilities. You see, the assets are like a whooping 21 million, I guess. No, 21 lakhs. Liabilities are like, 18 lakhs. So total amount of assets you have is far outweighing the amount of liabilities the company has, right? And if you're looking at his chart of the stock, right, just because the chart is going up, that doesn't mean that you need to invest in it. It must be dependent upon all sorts of other factors as well. So it has given 7,455% since 2002. Literally, like if you had just held on to a stock such as maybe HDFC Bank, obviously as the India grows, the banking sector is to grow with it, right? Because who gives the loans to all these big corporations? The banks give it. And which banks give it? The banks which have a large amount of money with them. Which banks have a lot amount of cash with them? It will be companies like HDFC Bank, ICICI Bank. They are private banks. Private banks are generally very profitable. It's because they take care of every single thing. HDFC is not just a bank where people park their money. They give loans to big corporations. They give credit cards. They also take care of home loans. They take education loans. They give all sorts of services. These private banks such as Kotak Mahindra, ICICI Bank, HDFC Bank, they are the largest banks in India by market capitalization. And as the Indian sector grows, we're also going to see these companies grow with them, right? It's as simple as that. So if you would just see, if you have just invested in Nifty, which is an average index, it consists of all the 50 companies, right? If you're going to look at the maximum, Nifty has given approximately 12.3% returns over a course of 20 years. Compare that with the other stocks in your portfolio. If you had just come up with your own portfolio of stocks in very good cash flow generative companies with strong moats, very strong balance sheets, you would have made a ton of money. Remember, compounding is the eighth wonder of the world. The one who understands it earns it, and the one who does not understand it pays it. It's as simple as that, right? So if you're a know nothing investor, you do not want to go through the process of selecting your own stocks, right? I mean, there's no magic formula for selecting stocks. Okay, there's no formula for selecting stocks. You can come up with your own set of stocks if you want. It's as simple as that. Okay, but do you have the ability to select stocks? Maybe that is debatable, but I believe that investing is one of the professions where you're gonna feel a lot of ups and downs. Just like life, you're gonna have some ups, you're gonna have some downs, but overall, what you need to see, are you going up? In the stock market, sometimes even investing in index funds, in 1 year you're going to be down 12%, 20%, right? When the 2008 crash happened, the market fell down by 58%. If you'd have just taken out of the money out of out of the market at that time, you would have missed the next 10 years that the market went on to this very big bull run, right? So it's very important to stick to an approach. Maybe you might be a small investor. Maybe you want to try in trading. Maybe you want to start investing. You want to be a fundamental investor. Maybe you want to buy only low PE ratio stocks. You want to be a value investor. It doesn't really matter, okay, if you're a small investor. But over time, all things revert back to their mean, right? Behind every stock, there is a company, right? It doesn't make sense for the stock to go up if the company is doing very badly. In the short term, things can be, the company might be doing very well, but the stock might not be doing well. But over long periods of time, the stock is going to generally follow the company. For example, if Apple is going to go bust tomorrow, if Apple is going to stop producing phones tomorrow, maybe someone, maybe the investors, maybe the people buying Apple phones have stopped buying Apple phones. Do you think the stock will be up? The stock will go to zero. It's as simple as that. So when you're selecting individual stocks, you do have high risk, but then again, it depends, right? Risk in the stock market refers to the intelligent effort that the investor is willing to put in. If the individual is not ready to put intelligent effort, he should stick with a passive strategy. He should just buy a low cost index fund and to just hold it till his retirement. It's going to be the best wealth making strategy for him. But if you are like me, you want to go through this idea, if you want to go through this art of investing where you want to select your own stocks and Sometimes the stock is going to be down 30%, but you should be quite resilient and hold on to it, and then maybe be part of the growth story of the stock. I think that's going to be a wonderful purpose for your life. Investing is interesting. That's true, and that's what Mr. William Bill Ackman also believes. Mr. Buffett also believes. So, thank you very much, ladies and gentlemen. I think this is it. We'll meet in a next video.